So good evening and welcome to the City of Virginia Beach's Opportunity Zone Open House. I'd like to thank the Ziders Theater for allowing us the opportunity to sit in this beautiful facility. It's a first-class facility. Many of you may not have been here in the past, and I certainly haven't, and it's quite a facility, and we appreciate that. In addition, I'd like to thank a couple of people who may or may not be here. I cannot see who's in the audience because the spotlight is very bright. But if Councilwoman Wilson is here, we're grateful that she has come. We also thank the representative from Senator Mark Warner's office for coming, and that would be Drew Lumpkin. And we'd also like to thank Deputy City Manager Ron Williams for coming this evening to help us with this production. There are numerous people who have volunteered to make this all come together. This is quite a job putting this all together, and there are far too many to acknowledge tonight, and I'd miss somebody and get somebody upset over it, so I won't name any names, but let it be known that I have a tremendous amount of gratitude for all the help that you've given in putting this first-class presentation together. My name is Ron Berkebile. I'm the city's economist. I've been with the city for about 12 years now, and I'll be the host and moderator for the program. And I see people still coming in, so come on in and find yourself a seat. We're just getting started. And we do ask for housekeeping purposes that if you have a cell phone that you please put it on silence or vibrate so that it doesn't interfere with our recording of the evening's session. This will minimize noise for rebroadcasting, which we plan to post on the website. So why have this event? Well, in 2017, Congress passed the Tax Cut and Job Act. Within the legislation, there's embedded this section called 1400Z, and in it, it's commonly referred to as the Opportunity Zone. The legislation as devised by the EIG think tank, which is out of Washington, D.C., really enabled capital gain tax relief through community-designated low-income zones to be enabled throughout the country, as well as Virginia Beach. In February 2018, the city identified 8 opportunity zones, and in March, the governor approved the city's zones, and then it went to the U.S. Treasury Department, and the U.S. Treasury Department then certified them. We're going to talk about those zones. We have a great speaker going to share some thoughts about them in just a few moments. So our zones are certified. If you have a business or an opportunity within those zones, we ask that you think about possibly using this incentive. Unlike most governmental incentive programs, though, the Opportunity Zone incentive administrative part doesn't fall upon the locality, which is a little bit odd for us. We're so used to having to carry the load of all the work associated with these incentives that it kind of made us step back a moment and think about what our role really is besides just establishing the Opportunity Zones themselves. Recognizing the potential for the city of Virginia Beach residents and businesses, I was sent to the city of New Orleans for the Opportunity Zone Convention offered by Novogradac, and acting as an ambassador, I just soaked up as much as I could from this conference. And the EIG leaders were there. They shared some thoughts about what the localities can do, and they didn't let us off the hook. They said, look, if you want this program to work, you need to start communicating it. For one thing, it is a little bit complicated. And so what we can do is act as an informational conduit for the community, the businesses, and those who are interested in possibly participating in the Opportunity Zone program. Plus, they said, the investors are going to probably take their time about this, so we need to keep repeating it and doing it over and over and over again so that they'll get why it's safe and why they should invest in these opportunity zones. We don't want them to miss anything, so you want to make sure that you do this immediately and as quickly as possible, because there are some timelines that we're going to talk about tonight that will really set the stage for whether you get the full benefits or don't get the full benefits or get partial benefits. To fulfill this project, the City of Virginia Beach asked 5 speakers to share their expertise with us. Our speakers are the best and the brightest Virginia minds in pertaining to the opportunity zones. We went out of our way to try to find the best that we could find, and not to say that anybody's lesser than them, but these are the folks that we felt were best suited for this opportunity to speak this evening. While many firms are waiting for clarification on some of the investment details associated with the opportunity zones, our speakers tonight have taken the initiative to go ahead and say, okay, well, this is what we have right now in legislation, and this is what we can do, and this is what the IRS has done for their first tranche of adjustments on the legislation, and this is what we think is going to happen on the second tranche of adjustments that will happen. So we feel like these speakers are like first movers, people who are really invested in trying to communicate the best of what opportunity zones can offer us now and look into the future. Tonight, we have a diverse group of people here with us. We have investors, we have developers, we have financial institutions, we have service providers, we have people from the energy industry, we have people from the medical fields, and we have people from manufacturing. After the presentations, our speakers will convene up front here in the panel area, and they'll answer questions, because you will have questions more than likely once the speakers have completed their topics. If you'll write your questions down and hold them to the end, we would be grateful, and that way we'll try to address all that we can. So tonight, our first speaker will be Mr. Steve Harrison. Steve started with the City of Virginia Beach in 2009 as an intern. In 2010, he accepted an offer to become Hampton Roads Economic Development Alliance Research Director. Missing his talent, the City of Virginia Beach went out and hired him back in 2012, and we're grateful for that. He's our Economic Development Research Manager. We're grateful for him, and many of the resources he's going to share with you, he developed, and we're grateful for that. Steve has been very instrumental in helping the Opportunity Zone team realize a presence on the internet, and he's going to briefly share available Opportunity Zone resources for potential investors and other informational conduits that are available to you. Please help me to welcome Steve Harrison to speak.
Thanks so much, Ron. The rest of the speakers are definitely the best in the business. I am the exception that is here to talk to you about the website, where you can find information from the best of the business. So the website that we have developed in conjunction with Ron Berkebile, and we really do want to thank him for his work putting this together tonight. He is a font of knowledge about Opportunity Zones, so we highly recommend contacting the city with questions. And the main portal to do that through is yesvirginiabeach.com/OZ, or Oz. We call Ron the Wizard of Oz. I'm the scarecrow because I'm just pointing you in other directions. But essentially what this does is it provides you with resources that you need to learn more about Opportunity Zones. One of the main resources is why you're here tonight, and that's these panel of experts. This is actually being videotaped, and so if you miss something or if you want to go back and review something that one of our speakers said, it will be posted on this website at the conclusion of this ceremony. So definitely don't worry if you miss something or want to get contact information or anything like that. All of it is available right here on yesvirginiabeach.com/OZ. And so one of the main things that you can do on this website is find out if your property or a property that you're interested in purchasing is in an Opportunity Zone. The map that you can see right here, you can type in your address, or you can just look generally at our 8 Opportunity Zones. I think if you've got any familiarity with them, you'll see that they're in very strategic business areas. A lot of them are over our strategic growth areas, which Kathy Warren and Ron Berkebile, who are subject matter experts on this, can talk to you quite a bit about. But other things that we have on the site are resources, just essentially overviews about what Opportunity Zones are. We've got reports on each of our zones and information about what essentially led them to becoming designated as those zones. But one of them is Corporate Landing Business Park, which is where those subsea cables are coming in and is really becoming a center of technology and cybersecurity. So these are zones that are prime for business. The zones directly adjacent to Town Center are considered Opportunity Zones. So we highly recommend that you take a good look at our 8 zones. I think that you'll be amazed at the opportunities that you can find there. Another thing is we have pulled the IRS guidelines. All of the guidelines that the IRS has already laid out about these zones are on our website. So rather than combing through the various documents, you can go straight to the website and read them yourselves. And our speakers will talk to you a little bit more about the final rules and regulations, which are still being crafted. Ron has created an investment example, so essentially what you could actually save or the taxes that could be deferred as a result of an investment in one of these zones. We've also got a prospectus. Two are currently on the site. We have 6 more that we're completing, and that is essentially city-owned land that is potentially available for a project in an opportunity zone. And so the SeaTac and Cleveland Street prospectus documents are already live on the website. The SeaTac covers a lot of the oceanfront area, and Cleveland Street is right here next to Town Center. The other 6 will come online in the coming days. And then there's just contact information. So if you have questions, contact us at the Economic Development Department. Our Director, Taylor Adams, and our entire staff are available to assist you, as are the Strategic Growth Area staff led by Kathy Warren. So we are grateful for the opportunity to work with you to take advantage of these zones, and we're really grateful to the speakers and hope that you get a lot out of this. Thank you so much.
Thank you, Steve, for letting the cat out of the bag about Wizard of Oz. Our next presentation has actually 2 speakers. Mr. Todd Roethlisberger and Stephen Lipskis will share insight into Opportunity Zone fundamentals. These are the basics that are needed in order to understand Opportunity Zones and how the businesses operate. They both work at Poole, Brook, and Plumlee Law Firm. Todd is the lead attorney in the firm's tax division of the business department. For more than 16 years, he has practiced tax and corporate law. During his career, he has assisted over 2,000 Hampton Roads residents and small businesses with tax issues. Mr. Stephen Lipskis specializes in estate, trust, tax, and elder law. In 2019, Coastal Virginia and CovaBiz magazine recognized him as the top lawyer in trusts and estates. Last year, Virginia Business Magazine recognized him as legal elite in taxes, estates, trusts, and elder law. Please join me in welcoming Mr. Todd Roethlisberger and Mr. Stephen Lipskis.
I'm Stephen Lipskis. I'm going to do the first part of our slides and then yield the rest of my time to Todd. First, this is going to be an overview of the zones. I didn't want to step too much on our co-presenters' toes, and also in the interest of yielding a fair bit of time at the end of the presentation for Q&A, we wanted to make sure that we could get through everything and address specifics. There are some complications in how you invest in these zones, and I know each of you will have excellent questions on that. Obviously, we are in the preliminary phases of the qualified opportunity zones, so we aren't yielding any specific legal advice to you. This is a general presentation, and we will definitely be shoring up some of the information as we get more regs coming out. So we're going to talk a little bit about the background and the change in the tax law, what is a qualified opportunity zone, how to identify the opportunity zone, and why consider investing in an opportunity zone. Again, it came from the Tax Cuts and Jobs Act that came at the end of 2017, and this was a pretty exciting part of it for many people because it was something that on a policy level had been talked about for many years and now was ready to actually be implemented into law. The proposed regulations came out towards the end of last year, so we finally got something to look at and potentially go by. We were looking at a hearing on those regulations at the end of January, which was delayed due to the government shutdown that was held last week on Valentine's Day on the rescheduled date. Jenny, who's going to present later, told me that she's expecting possibly at the end of next month to be getting further regulations. So as these things shore up on the compliance end, and we can move with more confidence in investing in these zones. But right now, the IRS has really given us enough on a lot of different types of investments to begin the process of setting up the funds and investing in these zones. Let's see. So what is a qualified opportunity zone? Well, it's a zone, it's a census tract zone that is a designated low-income area. So you're looking at areas that are within 80% or 80% or lower of the income in this region, in this metropolitan statistical area. That potentially could be considered as opportunity zones. So there are many zones that qualify. Not all of them were actually selected. There are other general qualifications, but that's one of the big ones for us because we are within an urban area. They're delineated by census tract, and as you can see there were 41,000 potential zones nationwide. With those 41,000 that were given to the states to look at and consider whether they wanted to designate them as opportunity zone, only 25% of zones within a state were eligible to be potentially selected. The process for selecting, as Ron discussed previously, really the localities helped a lot with it. But in the end, it was the chief executive officer of any state, so the governor in Virginia, who decided these are the ones I want to submit to the federal government and to Treasury to actually have certified. So again, the purpose is to encourage investment in really long-term investment. As we get through the later presenters, you'll understand why long-term investment is such a great benefit if it's the right situation to invest in one of these zones. So now we've got 3 in Chesapeake, 4 in Hampton, 7 in Newport News, 16 in Norfolk, 8 in Portsmouth, 1 in Suffolk, and most importantly for this topic of discussion, 8 in Virginia Beach that were just discussed previously. How were they decided? Again, nominating process that went through March, and then shortly thereafter everything was determined. They're really taking the position at the federal level, at the Treasury level, that the state is best to determine what are the best zones. They essentially took everything and said, okay, that's a qualified opportunity zone. That's what you submitted. We're going to allow it, move forward. So with that, I'm going to yield back to Todd to discuss the zones. These are the specific census tracts, and then also go into a little bit how these compare with other types of tax deferral options.
Thank you, Stephen. Again, my name is Todd Roethlisberger. I'm an attorney with Poolbrook Plumlee. First, I want to say I hope everybody joins me in wishing Stephen a happy birthday. It's his birthday today. What better way to spend it than talking about tax? Happy birthday, Stephen. So the list back here is the list of census tracts. The first Stephen went through part of that, so I'm going to kind of skip ahead a little bit. The second slide is a Southampton Roads regional view of these census tracts. So all the areas in blue there are the qualified opportunity zones. There is a website. It is called cdfifund.gov. If you go to that website, you can type in any address in the United States and really the territories of the United States, and it will tell you whether or not it is within a qualified opportunity zone. So that is a good function to have for those of you looking to invest outside the city of Virginia Beach. Of course, we encourage you to invest within the city of Virginia Beach. So why do this? Why invest in a qualified opportunity zone? There are 2 main advantages. First, you can defer the gain on the sale of a capital asset if you invest those funds within a qualified opportunity zone. Second, you can reduce the amount of capital gains that are paid if you retain that investment for a 10-year period of time. So you can elect, after 10 years, to step up the basis in that new investment that you made and effectively pay no capital gains tax. The last blurb there is something that's under the proposed regulations. We'll see when final regulations come out. But the last day to make the step-up increase in basis in your new investment is December 31st, 2047. They're giving people a lot of time to make these investments and make the decision about electing to step up and avoid that future capital gains. Things you're going to want to consider for making this investment. First, is there something appealing within a qualified opportunity zone? Is there something that makes sense to invest in within that zone, regardless of these tax changes and tax allowances? Should you be putting your money in that area? Second, you're looking at possibly reorganizing your business. You want to get a new headquarters, and you're looking for some tax advantages related to getting that new headquarters. You've had a liquidating event that creates a capital gain. You sold out on your Apple stock that's appreciated for the last 25 years, and you have this huge gain. You don't want to pay the tax on it. So had a liquidating event that created some capital gains. You had the sale of a secondary residence that doesn't qualify for the capital gains deferral of a primary residence. And also, you had a transaction that was poorly suited to a 1031 exchange. I'll get into a little bit of the differences between a 1031 exchange and these new qualified opportunity zones a little bit later. Again, it makes a good deal better, but it does not make a bad deal good. So you have to have something that is worthy of investment to begin with. As I mentioned, here's some differences between 1031 exchanges and qualified opportunity zones. Currently, 1031s are limited to real estate transactions. Qualified opportunity zones work with all capital gains. Second, the gain on the sale of capital asset is deferred until the sale of the replacement asset. For qualified opportunity zones, you're going to have to recognize the gain on your original sale by the end of 2026. We'll see if that changes also with some of the regulations as they come out. On a 1031, you have to invest the full amount of the sale in order for the gain. On a qualified opportunity zone, you're looking at just investing the gain portion. The replacement property in 1031 has to be identified within 45 days. You have 180 days under qualified opportunity zones to do that. Some of the other presenters are going to get into more of these details, but one thing that's important is in a 1031 exchange, it has to be a like-kind exchange, whereas there's no like-kind requirement in a qualified opportunity zone. Which taxpayers and what gains can be deferred? Virtually any capital gain that is eligible for deferral. So again, sale of stock, sale of a secondary residence, sale of a business that has a capital investment. Long-term, short-term, capital gains distributions, any type of capital gain. Eligible gains from, the sale or exchange cannot be to a related person, though. You cannot sell a piece of property to your brother or your sister and then elect to defer that gain. The gain cannot exceed, the gain deferred cannot exceed the amount invested in the qualified opportunity fund within 180 days. And virtually any entity that recognizes capital gains for federal income tax purposes is eligible to defer the gain. Individuals, C corporations, REITs, partnerships, other pass-through entities as corporations. And the last blurb there, partners and other pass-through owners can elect their own deferral if the entities do not. Qualified Opportunity Fund is the investment vehicle that allows you to invest money in the qualified opportunity zone. You must purchase an eligible interest in a qualified opportunity zone, fund to be eligible for the tax deferral. It has to be an equity investment. You cannot invest debt. And it cannot be a deemed contribution of money such as sweat equity. The fund self-certifies. There are no pre-registration requirements. The last part there is important. A deferral election can only be made for an investment to an entity that is a qualified investment fund. Therefore, you cannot choose to elect a month that your qualified opportunity fund is a qualified opportunity fund after you make the initial investment. You have to be investing into a qualified opportunity fund. You don't want to make the mistake of making the election after you've contributed the money. Then you would not be eligible for that gain. Thank you very much.
Thank you, Todd and Stephen. We appreciate that. Just to let everyone know, there's quite a bit of verbiage on these PowerPoints. We are going to post this on our website, so you'll be able to access this within the next few days after this presentation's come about. Now, tonight's next speaker is Miss Jenny Connors. We've kind of adopted her as our Opportunity Zone spokesperson. She, if you've been watching council or the Virginia Beach Development Authority presentations of yesterday. She presented to both of them yesterday and did a really fine job of it. She'll share her thoughts today, though, and about the establishment of qualified opportunity funds, opportunity zone funds. Jenny is a partner at the Williams Mullen law firm, is the chair for the firm's business tax section, and has practiced tax law for 12 years. Last year, she was tasked to form the firm's Qualified Opportunity Zone Practice Group, and since that time, she has spent significant time presenting and writing about the topic. In addition to advising clients, Jenny has been instrumental in forming several qualified opportunity funds and has several more in the pipeline. Jenny specializes in taxation of flow-through entities as well, and federal and state tax credit transactions. Please join me in welcoming Miss Jenny Connors.
Good evening, everyone. I would say since about this time last year, our firm has been overwhelmed with questions about opportunity funds and how to utilize this program and take advantage of the three benefits that Todd just mentioned, which are the deferral of eligible capital gain, a potential permanent tax reduction in that capital gain depending on how long you hold your investment, and then, of course, the third and best part, this tax-free appreciation concept on your investment into a qualified opportunity fund. And that leads to the question of what is a qualified opportunity zone fund. And an opportunity zone fund sounds like a really fancy term of art, and while it is a tax term of art, it's a fund, but not in the sense that you would think of a fund. A fund under this new statutory provision, an opportunity zone fund, is just a corporation or a partnership. If it's a tax partnership, it needs at least two partners that self-certifies with the IRS and says, hey, we're going to be an opportunity zone fund. The key part of an opportunity zone fund is the fact that it has to hold 90% of its assets in opportunity zone property. And that's the part that I'm going to be talking about tonight is while there are these great benefits associated with the OZ statute and the program, there are also these compliance aspects to it as well. And while I'm not going to get very deep into the compliance aspects, it's really important to understand that there is some complex planning that goes into these projects. And I'm going to talk a little bit about the potential structures that you might find yourself in to the extent that you're going to go down this path, either as an investor or a business owner or real estate developer, whatever your role in the transaction is. So as I mentioned, OZ funds have to hold 90% of their assets in OZ property. This compliance aspect of the statute is tested twice a year. It's tested at the end of the first 6 months of a taxable year and then again at the last day of the taxable year. So if you're a calendar year taxpayer, you're going to be looking to file compliance documents with the IRS as of June 30th and December 31st. If your taxable year, let's say your first year is less than 12 months of the year, they do adjust that timeline. The only thing I will add a caveat to is that we had an opportunity zone fund that was formed toward the end of 2018. It was actually formed in November, and their first testing period for compliance was December 31st, so it was not adjusted for them. So just keep in mind that you may want to build in more buffer than just a month to try and comply with this statute. So certifying as an OZ fund, I mentioned that OZ funds are self-certifying entities, and this was perhaps one of the best gifts that IRS and Treasury gave to this program, is this concept of self-certification. OZ funds certify on Form 8996 with the IRS. It is a 2-page form. So again, all you're doing with the IRS is saying, hey, we're going to be an OZ fund and we intend to comply with the OZ statutory provisions. And as Todd mentioned, you do have to be somewhat cautious about what day you select to start that OZ fund status. You do have compliance testing, as I mentioned. Your 6-month window depends on that month that you select OZ certification status. So be wary of the month that you select, and also if you have taken investments before you make that certification, those investments will not count under the provisions of the OZ program. So just be cognizant when you're selecting that date. So now we get into the more complicated area of this statute, and it's this concept of OZ property. And as I mentioned, an OZ fund has to hold 90% of its assets in OZ property. And what is OZ property? Well, the first type of OZ property is OZ business property, which is essentially tangible property that's held by an OZ fund. So we call this the direct structure because in this case, your OZ fund directly owns tangible property. OZ property, on the other hand, can be an interest in a subsidiary entity. So it can be an interest in a corporation or a tax partnership. And when I say tax partnership, LLCs are included in that concept as well. So we call that the indirect structure because in that case, you're not owning tangible property directly, you're owning OZ property, which is an interest in a subsidiary entity. And so first, we go to the OZ fund direct ownership structure. And this is a typical structure that you would see if you have direct ownership in OZ business property. And so if you look at the far side of the screen, this requires the OZ fund to own at least 90% of its assets in OZ business property. And what is OZ business property? I already told you it's tangible property. It's tangible property that's used in a trade or business. Per the statute, it has to be acquired after December 31st, 2017. This is one of the most common questions that I am getting these days is, I have property in an opportunity zone. I purchased it before 12/31/17. What do I do with it? And right now, I will say the only thing that we know to do is that you could potentially sell it. You could do a joint venture with it, but there are related party rules, so you would only be allowed to hold on to less than 20% of the interest in that joint venture. And that's not a great answer for a lot of people. So I think a lot of us are hoping that the second tranche of regulations comes out and answers that question in a better way, because theoretically, these folks who are holding on to, say, property that needs to be improved or vacant land, this would incentivize them to do something under this statute as well. So we'll see what future guidance says about that pre-12/31/17 property. The next requirement is that OZ property either has to be originally used within an opportunity zone, so that tangible property has to be the first use of that property within the zone has to begin with the fund. In the alternative, if it's existing within the fund, you have to do something to it. You have to substantially improve it. So if you own real property, for instance, within a fund or within an opportunity zone, you would need to spend more to improve that property than your cost of acquisition. And in the case of real estate, we got another gift from IRS and Treasury when they issued their guidance last October. They said in the case of property, real property, you can exclude the acquisition cost that you allocate to land. So if you buy land and you allocate a portion to a building and a portion to land, in terms of meeting this substantial improvement threshold, you can exclude your costs that you allocated to land. And finally, substantially all of your property has to be located within an opportunity zone for substantially all of the opportunity zone funds holding period for that property. And that works really well with real property. There are some testing issues that are going on with operating businesses that are not as real estate based, and hopefully, again, the future guidance from Treasury will give us some clarity on that issue. Now, if you look at the side of the screen that's closest to me, I will say this direct structure is very infrequently used. I have only done it once with one client who didn't have any other options, so they had to go into this direct ownership structure. But it's really inflexible and it's hard to use. And the reason is that only 10% of your assets can be comprised of cash, non-qualified financial property, intangibles, or tangible property that doesn't qualify as opportunity zone business property. So 10% is not a lot. And if you're a business that has a lot of working capital needs, if you're an operating business that has significant intangibles, this is just not a structure that's going to work for you. Really, the only type of business that works in this structure, I think, is real estate. And even then, you have working capital considerations. So even for real estate, this structure can be very difficult. And that is why you are seeing most people go into this type of structure, and I call this the indirect structure. And in this case, you have an opportunity zone fund that invests in an opportunity zone business. And then that opportunity zone business is subject to a whole other set of rules. And Mark is going to go through more of those rules that are applicable to opportunity zone businesses. But a couple of things to point out and why this structure is more flexible and tends to work well, not just for real estate businesses, but for operating businesses. And I would say operating businesses basically have to go into this structure. But one of the reasons is the 90% asset test is only tested based on how much equity you own in the OZ business. So if you own at least 90% of the OZ business's equity, you've met that test. The OZ business then is subject to a whole other layer of compliance and testing at its level as well. But notably, as you'll see down here at the bottom, an OZ business can have an unlimited amount of intangibles, so long as those intangibles are actively used within the conduct of a trade or business within the opportunity zone. So the key is they have to be used in the zone to better the zone and help it grow economically and help it develop jobs, and it has to bring activity within the zone. So again, another way that this adds some flexibility to the structure is that an OZ business only has to have 70% of its tangible property be opportunity zone business property. But there is no requirement that that OZ business have any opportunity zone business property. So you could have a company that owns most of its assets in intangibles and has very little tangible property. We've heard recently from a biotech company that's looking to move down to the Hampton Roads area. And as you can imagine, most of their assets are in intangibles. And under this structure, they can buy their own facility if they want to, or they could lease a facility. And in that case, this structure works well for them because still the majority of their assets at that point would be held in intangibles. This structure also works if you're looking to diversify some of your asset holdings. Because of that 70%, when you combine it with the 90% asset requirement at the upper tier fund, only 63% of your tangible property needs to be qualifying property. So we're seeing this structure used by a lot of businesses that are looking to diversify. We've also seen this structure used by companies who maybe are buying a tract within a zone, but there's an adjacent parcel that's not within the zone, and so they're trying to make that work through a diversified asset holding. There are some pros and cons to both structures, and this chart goes through the differences between the two. Again, as I mentioned, this is complex, and it takes some planning, and you want to make sure you're sitting down and making sure you can check the boxes either way. Obviously, the indirect structure requires you to have 2 layers of entities, which is additional filing requirements and additional compliance aspects, but it does give you more flexibility in what you intend to do with your business. So I'm not going to go through this, but this is a good chart to check if you decide to go down this path as a business owner or a developer to see just generally what structure would work best for you. And I've included some of the key provisions that I went over, and these relate again to the opportunity zone fund structures, the direct or indirect structures, and most of them relate to opportunity zone businesses, which is that second indirect structure and that lower tier entity in that structure. And I know Mark's going to talk more about these, so I'm not going to go through these. But the final point I did want to make, back to opportunity zone funds, to the extent that you're going to go out and raise money for either an operating business or a real estate development, it is entirely possible under the statute to have a mixed-use fund. And what they mean by that is if you have, let's say, half of your investors are eligible investors with eligible capital gains, and the other half are not, that's absolutely fine, and you can have a mixed-use fund. And we are setting up a lot of these right now. Typically, some percentage have the eligible gains and others do not, but if it's still a good opportunity with a lot of built-in potential for appreciation, you're seeing eligible and non-eligible investors coming into these OZ funds. All right.
Thank you, Jenny. As you can tell, it's quite complicated. We've had about a year and a half to kind of wrap our heads around it, and some of you may be sitting in here for the first time experiencing what opportunity zones or requirements are. So don't give up. Use the resources. We're recording this presentation, and we're going to post them on our website. Please feel free to use it as often as you wish. Our next speaker and our final speaker is Mr. Mark DeRoche. I would consider him the City of Virginia Beach's mentor. Mark has been instrumental in helping us to understand the intricate details associated with the opportunity zones. He'll share thoughts pertaining to the establishment of qualified opportunity zone businesses, as Jenny has pointed out here, the more flexible way of using opportunity zones. Mark is a member of the American Institute of Certified Public Accountants and has 36 years of public accounting experience in taxation and auditing with a concentration in real estate industry. Early in 2018, Mark introduced opportunity zone legislation to city staff, including myself, and former Mayor Will Sessoms. Upon zone certification, he immediately began working with property owners in the SeaTac and corporate landing opportunity zones. He has diligently kept himself abreast of IRS tranches, modifications, and adjustments by attending opportunity zone conferences. Please join me in welcoming Mr. Mark DeRoche.
Thank you, Ron. When the Qualified Opportunity Zone tax reform came into existence through the Tax Reform Act, it was thought to be a revitalization tool. And one of the best ways to revitalize a community is through the creation of new businesses, which lead to the creation of new jobs. Small businesses in the United States employ more than half of the private sector workforce. And in Hampton Roads, that's even more true. This law creates incentives for businesses when combined with other new tax incentives like the new 20% pass-through deduction for qualified business income and 100% bonus depreciation that leads this package to be a potential powerful package for new development and change. So I'm going to focus on qualified opportunity zone businesses. You know, startup businesses are really powerful opportunity zone opportunities. They require less capital to get off the ground. And when you're successful at building a small business, you can start with a modest amount of money. And then over a period of years, you can turn that into quite an investment. And that's one of the whole purposes of this opportunity zone is that you can take your investment, you can defer a capital gain into it, you can hold it, you can work it, and if you make it past 10 years and sell it, then it's tax-free. And it's like the American dream to me. This creates like a new class of assets. Because of the tax-deferred nature of these investments, they must be tracked separately. So I think as time goes on, we'll see that these are almost like a REIT was way back when REITs came around. Qualified opportunity zones will be similar. They'll have their own unique tax status and will be, needed to be tracked carefully. We've already talked a little about Form 8996, which is an IRS form, which is required to be filed annually. And, one of the main things I think on this form is that you have to identify your qualified opportunity zone property, and there's a 90% test. And this may sound kind of easy, but it's really not that easy because oftentimes you may have property that's originated outside the zone that maybe it's moved into the zone. You can have existing businesses, for instance, that are located out of the zone that want to move into the zone. Well, they're going to run into this 90% test if they have a lot of assets that are moving into the zone. So it's one thing to keep in mind. You need to have someone that's knowledgeable about what is a qualified opportunity zone property when they're preparing this form. Ultimately, if you're successful in business, you're going to be selling either stock, your partnership interest, or the underlying property. So this gives us a unique opportunity to create a double tax-free benefit, selling your ownership and selling the underlying real estate asset. Qualified opportunity zone business, as Jenny had alluded to, is tangible. It's tangible property, but that's both real and personal, and it's property that's acquired after 2017. And the original use must commence within the opportunity fund, or opportunity zone. So you have to use it first within the zone, or you have to substantially improve the property that you purchase and bring it into its original use. That can be done during any 30-month period. Requirements for qualified opportunity zone businesses. Well, they require that 70% of the tangible, real or personal property be used in the opportunity zone. They also require that 50% of the gross income is derived from an active conduct of business within the zone. And they also restrict non-qualifying financial assets to less than 5%. And the code also restricts certain what some people refer to as sin businesses. They're weird things like golf courses and massage parlors and suntan places and just stores that sell liquor is another one. So those things can't exist in an opportunity zone. So when you look at the underlying business, there's another set of rules, in which we just alluded to in the previous slide. But in order for the taxpayer to be considered a qualified opportunity zone business, substantially all, or what has been later defined as 70% of the tangible, owned or leased, and that's very important, property must be used within the zone in order to be qualified opportunity zone property. And as Jenny pointed out in great detail, you create a lot of flexibility when you set up an opportunity fund with a subsidiary underneath it. This is really done, it creates flexibility, it creates liquidity. And I got a couple slides that I'm going to kind of overlap a little bit with Jenny on. But so you get these combination tests. You get a 90% test, and we get a 70% test for the business assets. And you put those two tests together, you can end up with a 63% result. And a picture is worth 1,000 words to me, because it's a lot easier to see it when it's like this. So you have three investors with $1 million capital gains between the three of them. They contribute that money into a qualified opportunity fund, so there's $1 million in the opportunity fund. Now, the requirements say that 10% of those assets can be held in cash or other assets, and 90% must be invested within qualified opportunity zone property. And then if you set up the subsidiary, you get into these second-level tests, which require 70% of the business property must be opportunity zone property. So that creates a situation where you start with $1 million, 630 has to be qualified opportunity zone property, and 370, the sum of 100 and 270, can be other investments outside the opportunity zone or diversification to hedge your risk, whatever you're trying to do. This is the right structure. And we'll see. It adds some complexity to the whole thing, but it's clearly the way to go. And I think this slide kind of makes it easier to understand. When the regulations came out in October of 2017, they included a new concept called the 31-month safe harbor working capital, which allows the buildup of capital to make substantial improvements. Before this rule came out, the code really, under number 2, you'll see, there's a lot of concern about the timeline to get money into a fund and ultimately get it into a project. So the regulations address this by creating this 31-month period. And within that 31-month period, there's other benefits that you can derive from during that period. Number one is during that time period, your working capital counts towards your 50% test and your 70% test. So you're kind of free from worry for 31 months while you're building assets, making plans, going through zoning or whatever you got to do to get yourself into a project. When you combine the 31-month with the 180-day rule, you can really think of it as you got 37 months from the time you incur a capital gain to the time you're into the project. So I guess when the IRS came up with these regulations that they were thinking 37 months or 31 months was enough time. I think it's still a little tight, but that's what we got to work with. Another benefit that comes out of this rule is that there's no stipulated limit to the amount of funds that can be accumulated in your working capital fund during this 31-month safe harbor period. And there can be series of gains that are added during this 31-month period to sort of build up your war chest to make sure your loan to values are right when you get ready to build. So it's very, very useful. In order to use the 31-month safe harbor, you must have a plan. The plan must be in writing. It must be for the acquisition, construction, and improvement of the property. You must have a schedule, and you must follow that schedule. So let's think about what we got now. 2018, this law came out. In 2018 and 2019, the law allows for a 15% deferred benefit if you defer your capital gains into an opportunity fund. Ultimately, you're discounting your tax obligation, and you're also gaining the time value of money on that because it's not due till 2026. So why did they set it up this way? Well, I think they set it up this way because they recognize that there's $6 trillion of unrealized gains in the stock market. And there's never been a bridge from the stock market to real estate. There's never been a bridge from paying tax on your stock market gains to invest it into a small business. This qualified opportunity zone is the first bridge we've ever had. So funds are starting to recognize this on a national level. And these funds are accumulating quite a bit of money. There's funds out there that have $500 million. There's funds out there that have $1 billion. In 2019, people are starting to figure this out. More people are trying to find ways to get out of their capital gains taxes, and they're recognizing the opportunity zone is the answer for that. So these opportunity funds are really, really important. They're accumulating these funds, and what they're looking for is shovel-ready projects. And in fact, if you look around, there's probably more money than shovel-ready projects. But I'm going to go out on a limb here. We have a shovel-ready project here in Virginia Beach, and it's the Convention Center Hotel. It lies in the SeaTac Opportunity Zone, and maybe it will be found by a national qualified opportunity fund because they're looking for shovel-ready projects. We're going to do some examples now. I feel like pictures help to understand some of these complex concepts. So we have a startup business. Initially, we have two investors who each have $200,000 in capital gains from, let's say, the stock market. They defer it into a qualified opportunity fund. The qualified opportunity fund puts the money into a new startup, Top Burger Inc., which business is organized as a subsidiary. So I call it the business QOZB. The business finds an old building in the zone and substantially improves the property. The new business, or the investors in the new business will qualify for capital gain deferral, and if they hold it 10 years, capital gain exclusion, which exclusion means the elimination of capital gains tax. Top Burger, in this example, raised $400,000. Well, that wasn't quite enough for them to accomplish their objective to build out a facility. So they reached out to some other restaurant associates who had their own qualified opportunity fund, $200,000. They can invest into the qualified opportunity zone business and defer their gains just like Top Burger did, Top Burger's investment did. So it's a way of attracting capital to new businesses. It's not just the original investors, but it can be outside investors that like your idea, that pool their money in to make great ideas reality. Qualified opportunity zones provide strong incentives to technology startups. If you think about it, there's a huge payoff for creating an emerging new technology company. And if investors defer capital gains into such a startup organization, and they come up with this magical idea that they're able to bring to market and go public with it, if they're located within a qualified opportunity zone and they meet the holding periods, they can bring a company public and not have to pay tax on the gain. That's pretty amazing to me. Same thing's true for, I mentioned tech, but pharmaceutical, biomedicals, they're awesome industries for qualified opportunity zones. All you need is a capital gain deferral. We need a capital gain deferral to make the tax exclusion on the backside work. So let's do another example. Let's take a government contractor. We got Secure Tech, which is a struggling new technology company, and it has a new security technology product. Secure hires some key staff who come up with some great ideas. But then they recognize the benefits of relocating into a qualified opportunity zone. They decide to lease a property within the zone and newly equip it with state-of-the-art technology equipment, furniture, and fixtures. They recapitalize their company with deferred capital gains. So they meet the asset test, and they've deferred the capital gains. So they're a qualifying business at that point. So Secure then lands a government contract, and this increases the value of that small business. They can continue to work that small business on their own for 10 years and then maybe sell out, and again, the sale of their business will be tax-free. Or they can use it to attract outside investors. New business opportunities work well for franchises. All right, in my example, two guys, one an investor, the other a business operator. They both defer capital gains into separate QOFs, qualified opportunity funds. The real estate investor wants to own the real estate and lease to the franchisee. The real estate investor makes substantial improvements to the building, and so he will qualify. That building now will qualify as a qualified opportunity zone property. And the franchisee, well, he doesn't have quite as much money as the investor. So he's improving the inside of the building, and he outfits it with leased property. Okay? It's less money, but that counts. So both of these guys meet the requirements for capital gain exclusion if they, hold this investment 10 years. So small businesses, create a powerful impact on low-income communities, and I'm hoping that we can see this become a reality. Thank you very much.